I'm going to show you a single line you can put on any chart that tells you where price is most likely to go next. And I know that sounds like a bold claim, so let me prove it to you right now before I explain anything. Look at this chart. Just price. Nothing else. I want you to actually guess. Is this about to go up or crash down? Go ahead. Say it out loud. The truth is, with just candles on the screen, you're guessing. It looks completely random. There's no way to know. Now watch what happens when I add one single line. This line right here. Suddenly the chart isn't random anymore. You can see price gets pulled toward this line, reacts off it, and turns. What looked like chaos a second ago now has a clear, readable pattern. That line is what I call the magnet level. And by the end of this video, you'll see it on every chart you open. Now I want to be upfront with you. This is not a quick 5-minute tip video. This is a complete course. Over the next 20 minutes, I'm going to take you from knowing nothing about this to understanding it better than 95% of the people trading out there. We're building this from the ground up, so if you're serious, stick with me the whole way. Save this video. You're going to want to come back to it. Here's our roadmap. First, why this even works, the thing big money can't fake. Then how to actually read the magnet level, the psychology behind why price reacts to it, the free tools to set it up, the core strategy with real examples, then an advanced tweak that completely changed my entries, and finally, risk management so you protect your money. 2 things I'll mention now and come back to later. The exact line I just showed you, and one small tweak that fixed the biggest mistake I was making. Keep both in the back of your mind. Let's start. Before any lines or charts, you need to understand the one idea this entire strategy is built on. And it's this. The big players, the institutions, the funds, the whales, they can fake price, but they cannot fake volume. And once you understand the difference, everything clicks. Here's the difference. Price is just the last number someone agreed to trade at. A big player with enough money can shove price around for a moment, push it up to trick you, or slam it down to scare you. That's easy for them. But volume? Volume is the actual amount of trading that happened. How many contracts, how many shares actually changed hands? You can't fake that. If 1,000 contracts traded at a price, 1,000 contracts traded, period. Think of it like a concert. People can tell you they were standing anywhere they want. They can lie about it. But if you look at the floor afterward, the worn-out patch, the trash, the spilled drinks, you can see exactly where the crowd actually gathered. The biggest mess marks the spot where the most people stood. Volume is that worn-out patch on your chart. It shows you where the real crowd, the big money, actually did their business. They can lie with price. They can't lie with the footprints. So lock this in before we go further, because everything else builds on it. If we can see where the most trading actually happened, we can see where the big money actually is. That's the whole foundation. Got it? Good. Let's go find that spot on the chart. Real quick before we get into the charts, and this ties right into what we just talked about. I want to tell you about Alertsify, because everything we just said about big money and not being able to fake the real activity, that's exactly the problem Alertsify solves for you. Here's why it's different from every other signal service out there. Every single trade on the platform is verified straight from the broker, not screenshots somebody could fake, not made-up results. Real trades from real professional traders pulled directly from their broker account. And the second one of those pros takes a trade. Alertsify copies it straight into your account, automatically, in under a second. You don't have to do anything. Now yes, the Pro plan is $1,997. I'm not going to pretend that's pocket change, but most people make that back within the first month just from copying the traders on the platform. So while you're here learning how this all works, you can actually be earning at the same time by following the pros. The link is in the description. Go check it out. Now let's get back to it, because this next part is where it gets good. Okay, most traders have seen volume before, those bars along the bottom of the chart. But those only tell you how much trading happened at each point in time. Monday, Tuesday, this hour, that hour. Useful, but it's missing the most important thing. It doesn't tell you at what price all that trading happened. And the price is what we actually care about. This is the volume profile. Instead of bars along the bottom, it's bars along the side, turned sideways. And now each bar lines up with a price level. The longer the bar, the more trading happened at that exact price. This one tool flips everything. Now you're not looking at when people traded. You're looking at where the money actually sat. and that changes everything. Now look at the bars. Some are long, some are short. The long ones, that's where heavy trading happened. Lots of money changed hands at those prices. The short ones, barely anyone traded there. Price just passed through quickly. And the single longest bar of them all, that right there is the magnet level. The price where the most money in the entire range changed hands. This is the line I showed you at the very beginning of the video. That's it. That's the secret line. And here's why I call it the magnet level. Watch what price does around it. It drifts away, and then it gets pulled right back to it, again and again, like a magnet. Because that's the price level where the most business got done. Price keeps gravitating back to it to do more business. Once you start seeing this, you can't unsee it. There are two more lines worth knowing. Around the magnet level, there's a zone called the value area. It's marked by a high line and a low line, and the space between them captures 70% of all the trading that happened in this range. Think of it as the comfort zone, where the market spent most of its time and felt fair. Above it, price is expensive. Below it, price is cheap. The magnet level sits right in the heart of it. Let's lock this in with a quick exercise. I want you to actually pause the video right here. Look at this profile. Find the longest bar. That's your magnet level. Got it? Now unpause. If you pointed to the longest bar in the middle here, you nailed it. That's the magnet level. See? You're already doing it. Lock it in. The longest bar on the volume profile is the magnet level. Price gets pulled back to it like a magnet. That's module 2 done. Now let's talk about why price reacts there, because this is the part that turns you from someone who sees the line into someone who can trade it. So here's the question. Why? Why would price care about some line drawn from old volume? It's not magic. There's a very real reason, and it's all about the people who traded there. Remember, the magnet level is where the most trading happened. That means the big players built huge positions right at that level. Millions of dollars committed at that exact price. Now think about what that means for them. They have a massive stake in that level. Their profit depends on it. They are not going to just let price blow through it and ruin their positions. They will defend it. So here's the psychological war happening behind the scenes. Price moves away. Then later, price comes back to the magnet level. The moment it touches, those same big players who built positions there spring back into action. They pile back in to defend their level, and all that buying or selling pressure pushes price away again. That reaction you see on the chart, that's not random. That's the big money defending their turf. The simplest way to picture it, it's a line in the sand. The big money drew it by trading heavily there, and every time price comes back to that line, they fight to hold it. That's why these levels are so reliable. You're not predicting the future. You're just standing next to the biggest players on the field and reacting when they react. And that brings us to the good part, because now that you understand why price reacts to the magnet level, I can show you exactly how to turn that reaction into a trade, with real entries, real stops, real targets. That's next. Lock it in. The big money defends the magnet level because their positions depend on it. So when price returns, expect a reaction. Module 3 done. Now let's actually put this on your charts. Everything I'm about to show you is on TradingView, and the tools you need are completely free. There are 3 versions of this tool. Let me walk you through each one and tell you which ones actually matter. First, the anchored volume profile. You'll find it in the toolbar on the left side of your chart, sitting just above the brush icon. This is the one you'll use most. You click where you want your analysis to start, usually the beginning of a clear trading range, and it builds the profile from that point all the way to current price. Here's the simple way to use it. Find a clear range on your chart, where price has been moving sideways or within obvious boundaries. Anchor your analysis at the start of that range. Click. And there it is. Your profile builds out. The longest bar shows your magnet level, and now you've got your line. That's the whole setup. Second tool, the fixed range volume profile. Same idea, but with one key difference. The anchored version always includes current price. The fixed range lets you put a profile on just a chunk of old history, without current price. Why does that matter? Because old magnet levels still work on today's chart. Watch. Price broke out of this old range, came back later, and reacted right at the old magnet level. These old levels give you extra trade opportunities most people never even see. Third tool, the session volume profile. And here's where I'm going to save you some money. This one needs a paid TradingView subscription. but you do not need it. The only thing it does is automatically draw a profile for each trading session. That's it. The free fixed range tool does the exact same job. You just place it manually, which takes a few extra seconds. So if the only reason you were thinking about upgrading was this tool, keep your wallet closed. The free version is all you need. One quick setup tip. When you open the settings, change the colors so it's easy to read and doesn't clash with your candles. I like up volume in blue, down volume in yellow, the value area lines in blue, and the magnet level in bold red so it really stands out. Set the value area to 70%. Now everything's clean and you can read it at a glance. Lock it in. 2 free tools, anchored and fixed range, are all you'll ever need. Skip the paid one. Module 4 done. Now the part you've been waiting for. The actual strategy. Here's the core strategy, and it's beautifully simple. Step 1. Find the magnet level, the longest bar. Step 2. Wait for price to move away from it. Doesn't matter which direction, you just need separation. Step 3. When price comes back and touches that level for the first time, you take your trade. And I want to stress one word there. First, the first touch is the strongest. Every retest after that gets weaker, because each time, some of those big players have already closed their positions. Let's walk a real bullish example, step by step. Here's our chart. We anchor our profile and find the magnet level, this red line. Price rises up and away from it. Good, we've got our separation. Now we wait. And here it comes. Price pulls back down toward the magnet level. Price touches the magnet level for the first time. This is our signal. Those original buyers who built positions here defend their level, and they drive price right back up. We bought at that first touch, and price launches higher to our target. Clean, textbook. That's the long setup. Now the bearish version, it's the exact same logic flipped. Here's a different chart. We find the magnet level. This time price falls away from it, down. We've got our separation to the downside. Then price pulls back up toward the level. Price comes back up and touches the magnet level for the first time. The original sellers who dominated this zone reactivate and slam price back down, protecting their positions. We shorted at that first touch, and price drops to our target. Same strategy, just upside down. Long on the first touch after an up move. Short on the first touch after a down move. Before we go on, let me save you from the 3 mistakes that kill this trade. 1. Trading the third or fourth retest instead of the first. The power fades each time. 2. Using a weak magnet level that isn't clearly the longest bar. If you have to squint to find it, skip it. 3. Entering when price never actually moved away first. No separation, no setup. Avoid those 3 and you're ahead of most traders already. Lock it in. Trade the first touch back to the magnet level after price has moved away. Long after an up move, short after a down move. Module 5 done. Now, remember that tweak I promised you at the very beginning? It's time. This is the thing that fixed my biggest problem. Okay, here's the tweak. Early on, I kept running into the same frustrating problem. I'd mark my magnet level, wait patiently for price to come back and touch the exact line. And price would react just before reaching it. It'd reverse a hair short of my entry, and I'd sit there watching a perfect trade run away without me. Over and over. So I figured out why, and how to fix it. Here's the breakthrough. The magnet level isn't really a single line. It's the center of an entire zone of heavy volume. The big players didn't all trade at one exact price. They traded in a cluster around it. So the real defensive area isn't the line itself. It's the whole zone of thick volume bars surrounding it. The line is just the middle of the fortress. So here's the fix. Instead of waiting for the exact center line, I enter at the edge of the zone, the moment price reaches where the heavy volume begins. If price is coming down from above into a bullish setup, I buy at the upper edge of the zone. If price is coming up from below into a bearish setup, I sell at the lower edge. I'm catching the reaction right where the institutional activity starts, instead of waiting for a center line that price often never quite reaches. Let me show you the difference side by side. On the left, the old way, trader waits for the exact line. Price reverses just short of it. Missed trade. On the right, same setup, but I entered at the edge of the zone. Price reacted exactly there, and I caught the entire move. Same chart, same level. One small adjustment, and a missed trade becomes a winning one. Here's one more, so it really sinks in. Price drops toward our volume zone. Using the old method, you'd be waiting down at the center line. and price never gets there. But with the zone edge entry, we buy right here at the top of the heavy volume, and price immediately launches. That's the tweak. Small change, huge difference. This single adjustment caught me more trades than anything else I've ever changed. Lock it in. Don't wait for the exact line. Treat the heavy volume as a zone and enter at its edge. That's the loop closed. The tweak I promised you at the start. Module 6 done. Now let's protect your money. A strategy is nothing without risk management. So here are 2 simple rules that fit perfectly with everything we've learned. Just remember this line. Stop behind the wall. Profit before the next wall. Let me show you exactly what that means. First, your stop loss. It goes behind a heavy volume wall in a low volume area where barely anyone traded. Why there? Because the heavy volume zone is your wall of defense. If price pushes all the way through that wall and into the empty low volume space beyond it, the level has failed and there's nothing stopping price from running. That's your signal to get out. So you place your stop just past the wall in the dead zone. If you're hit small and you're hit for a good reason. Second, your take profit. You bank it just before the next heavy volume zone. Here's the logic. A heavy volume zone acts like a wall in both directions. If you're short and price is falling toward a big volume zone below, that zone could act as support and bounce price right back against you, so you don't get greedy and aim past it. You take your profit at the start of that zone before it has a chance to reverse your trade. Take what the market gives you. Lock it in. Stop loss goes behind a heavy volume wall. Take profit comes before the next heavy volume wall. Simple, logical, and it keeps you safe. Module 7 done. Let's wrap this whole thing up. Let's stack everything you just learned. 1. Big money can fake price, but never volume. 2. The longest volume bar is the magnet level. 3. The big players defend it, so expect a reaction when price returns. 4. Trade the first touchback after price moves away. 5. Enter at the edge of the zone, not the exact line. And 6. Stop behind the wall. Take profit before the next wall. That's the entire system. You now understand this better than almost everyone trading out there. Now go do it. Open TradingView, add the anchored volume profile to a clear range, and find your first magnet level. Then just watch how price reacts to it. Don't trade real money yet. Just train your eyes until you can spot these in your sleep. And do me a favor, save this video. This is the kind of thing you'll want to come back to as you practice. Drop a comment and tell me what strategy you want me to turn into a full course next. I read every single one, and if this taught you something real today, hit subscribe. I break down one complete strategy like this every week. Simple, clear, no fluff. See you in the next one.